I don't think we're facing a major banking crisis, nor were we a year ago. We were facing some defaults, and they've been less than I expected. I think we will see some American banking failures going forwards, particularly the smaller regional banks, which are focused on mortgages. The real problem the banking sector had and still has, and it's not gone away, is the problem of borrowing short term, that is, they take money from their depositors and they have to repay them at notice, and lending long term. So when they lend long term, they've done two or three types of things. The first one is the mortgages. So these mortgages will be 5, 10, 20, 30 years, depends on the country. I think in America it's quite long-term mortgages. In the UK it's much shorter, where they fix it maybe for 4 or 5 years. The second thing is they're lending to corporations who quite obviously can't immediately pay when they borrowed money to buy a factory or whatever they're doing. So that, to all intents and purposes, is long-term lending. And typically corporations will want to have a fixed interest rate for a number of years, so they'll have fixed the interest rate there. And the third type of lending they'll have done, so third type of investing, which is when they deploy their assets, will have been to put it into government bonds. Now, all of that will have happened over the last decade, when interest rates were as close to zero as makes no difference, which means the interest rate that they are earning on these fixed interest loans is quite low. Certainly it's lower than what they have to pay their depositors to keep the money in the bank. Now, many depositors don't care, they're leaving their money and earning nothing. But realistically speaking, there's an ongoing movement by depositors to say, I can get 5% in a money market fund. I'm taking my money out of here and I'm going to put it in a money market fund. And the money market fund would be putting their money in the USA, for example, with the Federal Reserve, where they can get 5% and completely safely. So the banks have got this situation that they have short-term depositors who they have to repay at notice, and they have these long-term loans which they can't get back at short notice. If they sell their liquid assets, which are the treasury bonds that they'll own, they're going to be selling them at below the price they paid, which is a loss. And the problem with this is with banks is to what extent are the losses that banks have made on these treasury bonds, on their loans, on their commercial real estate loans, on all the loans they made, to what extent are those assets, because they are assets of the bank when the bank lends money, to what extent are those assets worth less than the deposits, their liabilities that they've taken in? If the difference is greater than their capital and reserves, then the bank is insolvent and some sort of action needs to be taken. And that might mean it goes into administration and the Federal Reserve the Federal Deposit Insurance Corporation steps in and provides compensation for the investors who want their money out, and maybe the bank gets taken over by a larger bank.